A car insurance deductible is the amount you pay out of pocket before your insurer pays a covered claim. It sounds like a small detail until an accident happens and the repair bill arrives. If your deductible is $500 and a covered repair costs $3,000, you usually pay the first $500 and the insurer handles the rest according to the policy. The deductible decides how the loss is shared. Collision coverage can make the surface story look simpler than the real situation. Deductibles are common in collision and comprehensive coverage. Collision applies when your car is damaged in a crash. Comprehensive often covers events like theft, vandalism, fire, falling objects, or certain weather damage. Comprehensive coverage is often the detail that separates a quick reaction from a wiser response. Liability coverage usually works differently. If you damage someone else's property or injure someone and the claim is covered, your liability coverage may pay without the same kind of deductible. Policy details and local rules matter. Liability working differently shapes what should be checked next. Choosing a higher deductible usually lowers the premium because you keep more of the first loss. Choosing a lower deductible usually raises the premium because the insurer takes on more of the early cost. Premium trade-off turns the idea into something practical rather than only theoretical. The cheapest monthly premium is not always the best choice. A driver with a high deductible needs enough savings to pay it quickly after an accident. Otherwise, the car may sit unrepaired while the owner searches for money. Cash reserves deserves attention before the choice becomes harder to reverse. A low deductible can help drivers who cannot handle sudden costs, but it may not be worth the higher premium if claims are rare. The decision depends on cash reserves, vehicle value, driving risk, and comfort with uncertainty. Per claim deductibles can quietly move the cost from the present moment into the future. Deductibles may apply per claim, not per year. If two separate covered incidents happen, the deductible may apply twice. That surprises people who think one deductible covers every event during the policy period. Separate incidents helps explain why the obvious answer may not be the best answer. Imagine a driver hits a pole and pays a collision deductible. 2 months later, hail damages the car and the comprehensive deductible applies. The events are separate, so the out-of-pocket cost may appear again. Different deductibles by coverage gives the situation its real-world weight. Some policies have different deductibles for different coverage types. Collision may have one deductible, comprehensive another, and glass coverage may have special rules. The declarations page usually lists these amounts. Small claim decisions is worth checking when the first explanation feels too neat. A deductible can affect whether it is worth filing a small claim. If the repair costs $600 and the deductible is $500, the insurer's payment may be small. The driver may also worry about future premium impact. Premium impact after claims can decide whether the problem stays small or grows into a pattern. Premium increases after a claim depend on fault, claim type, insurer rules, driving history, and local regulation. The deductible is only one part of the decision to file. Vehicle value keeps the analysis tied to behavior, money, timing, risk, or trust. Vehicle value matters. A very old car with low market value may not justify expensive collision or comprehensive coverage. If the maximum payout is small, the deductible and premium may consume much of the benefit. Lender requirements belongs in the decision because it changes what action would help. Leased or financed vehicles may require certain coverage. The lender wants protection for the car because it still has financial interest in the vehicle. Drivers should check requirements before reducing coverage. Deductible as pricing agreement becomes more reliable when it appears more than once. Deductibles are not penalties. They are part of the pricing agreement. The insurer charges a premium based partly on how much of the first loss the driver agrees to keep. Comparing more than premiums should be checked before accepting the most comfortable explanation. The common mistake is comparing policies only by monthly price. A lower premium with a much higher deductible can be expensive after one claim. The real comparison includes premium, deductible, coverage limits, exclusions, and claim service. Emergency planning needs to be connected with the actual consequence. Another mistake is forgetting the deductible during emergency planning. A driver should know where the deductible money would come from after an accident. Insurance works better when the out-of-pocket part is already planned. Repair timing keeps the topic grounded in daily life. When reviewing options, ask how much you could comfortably pay tomorrow if the car were damaged. That number may be a better deductible guide than choosing whatever makes the premium look lowest. Comfortable out-of-pocket amount can be found in behavior, documents, timing, or repeated choices. Car insurance deductibles matter because they decide the first financial shock after a covered loss. The policy may be active, but the driver still needs to handle their agreed share. Covered loss shock makes the issue easier to name in plain words. The practical takeaway is to choose a deductible you can actually live with. Saving a little every month is not helpful if the deductible is so high that a covered claim becomes financially stressful. A deductible changes how small claims feel. If a repair costs $600 and the deductible is $500, the insurer may only pay a small amount after the deductible. Filing the claim may not be worth the time, record, or possible premium impact. Drivers often choose deductibles while shopping for the cheapest premium, but the real test happens after a claim. A low monthly bill can feel smart until the driver has to produce a large deductible quickly. That does not mean high deductibles are bad. It means the deductible should match the driver's cash cushion, not only the desire to reduce the premium. Choosing a higher deductible often lowers the premium because the driver keeps more of the small loss risk. That can make sense for someone with emergency savings. It can be painful for someone who cannot comfortably pay the deductible after an accident. Another detail is claim size. For a small scratch, the deductible may absorb most of the repair cost. For a major collision, the same deductible may feel minor compared with the total bill. Understanding that difference helps a driver decide when to claim, when to pay privately, and when to focus on preventing losses. Deductibles can vary by coverage type. Collision, comprehensive, glass, and special coverages may not all work the same way. A driver should know which deductible applies before assuming every claim has the same out-of-pocket cost. It also helps to decide in advance how small claims will be handled. If a driver knows they would pay minor damage out of pocket, they can choose a deductible with that behavior in mind instead of guessing during a stressful claim. A car insurance deductible is the part of the loss the driver agrees to handle before insurance starts helping. The right deductible balances monthly savings with what the driver could actually pay after a bad day on the road.